Hi, I'm Devin Schutz, and welcome again to the Money Minute. So Lennon famously said once that there are decades when nothing happens, and there are weeks when decades happen. Now, last week certainly had a few decades packed into it. The US has continued to dominate headlines with a barrage of drastic and far-reaching trade policies. The markets and businesses have tried in vain to grapple with this fluid landscape. But the uncertainty over what Trump's administration's trade policies will mean for the globe has ultimately heightened market volatility. Now, while volatility is a price that investors pay for owning assets that should deliver significant long-term capital growth, it isn't easy to handle. In times like these, our instincts may compel us to run for safety. This could mean exiting the markets, sitting in cash, and waiting for things to calm down. The problem with this strategy is that the best days in the market often occur very closely after the worst days, meaning it is almost impossible to get the timing right. I'll give you an example of this that happened last week. In the few days prior to that, markets had sold off significantly, with the S&P 500 down almost 15%. However, Wednesday saw an announcement of a 90-day delay on the tariffs, and this caused the S&P 500 to rally almost 10% in a single day. This demonstrates that short-term market movements can be incredibly fast and incredibly unpredictable. So for investors to give themselves a high probability of success, they need to focus on the longer term and have a partner who can guide them through the volatility. Now, while we can't predict the future, TRG has a proven track record of successfully navigating uncertain markets for our clients. Our strategy of long-term decision-making, rich diversification, and utilizing some of the best global managers around has served our clients well for many years, and we believe it will continue to do so in the current markets. Thanks as always for watching. Have a great week.